What is the difference between the Fed rates and mortgage rates? What do they have in common? This is something that we get questions all the time, so I figured I might as well go ahead and make a video that I'm going to explain in simple English. What is the difference between the Fed rates and mortgage rates, and what do they have in common, and what do they not have in common? So first, we're going to start with some definitions, but before I dive into that, I want to make sure I introduce myself. My name is Christian Stubbs. I'm a team leader and owner of Onyx Homes, and I make videos like this to give you as much information as possible. So let's kind of dive right in. Now, before I dive into the definitions, I want to make a point here. I'm not an economist. I am not a finance person. I'm going to give you a third grade perspective of this so that we can both understand it from the point of view of somebody that's in the real estate business. So for the record, I'm going to make this as simple as possible. So there's going to be a lot of details that I leave out, but I think I'm going to hit the major points so that we can understand it. So let's dive in. The Fed is the first thing that I'm going to talk about. So what is the Fed? Well, the Fed, when you hear that, it stands for the Federal Reserve. And what does the Federal Reserve do? Well, put very simply, they lend money to banks. And this is the short-term interest that the banks pay, and then the banks go and lend the money to you. So obviously the banks are borrowing the money from the Fed at a lower rate than they're borrowing or than they're giving the money out to you. So this is what we're talking about when you hear the Fed or the Federal Reserve and the federal funds rate. This is the rate at which the Federal Reserve lends money to the banks, and then they go and lend that money to you. So while these rates are connected, they're not the same. So I'm going to make a few major points that I want to make sure I drive home for you here. Is that number one, the first major point is that the federal funds rate does not equal mortgage rates. So that's number one, first and foremost. Just because the federal funds rate changes, because the Fed changes what the rate is, that does not directly affect mortgages or any other type of interest rates. So the real question is, how does the Fed's rate affect mortgages, which affects you and I, especially if you're thinking about making a move? Well, this is how it works. Is think of it from the bank's perspective. And I'm saying bank meaning the lending institution, the person who's lending out the money for the mortgage. They are looking to loan out a mortgage under a long term, 30 years being the most popular mortgage loan term. So a bank is going to be borrowing money from the Fed and then loaning it out for 30 years, and they're not going to make their money back for quite some time. But there's another layer in this as well too. Almost all mortgage loan originators, so when you go to even a bank like Chase or Wells Fargo, they might actually keep the loan, but most lenders that generate mortgages will actually sell off the mortgages. And there's large institutions that buy up thousands and thousands of mortgages all at one time, because it's easier for them just to buy a whole bunch of them and pay a little bit of a premium, so that way they don't have to go and find people like you and me to actually do the mortgages themselves. Now, one thing that's important to understand is that mortgage loan originators are kind of thinking for the long term, certainly much more than the Fed is thinking of what do we need the rates to be at right now. When you're loaning a borrower a 30-year mortgage, obviously it's going to take a lot of time before that loan is paid off. But the reality is a lot of loan originators are actually selling that loan off to a larger institution that'll buy a whole bunch of mortgages all at one time. And my point for this is mortgage rates move in anticipation of what the Fed is going to do. So on a day-to-day basis, if you look at mortgage rates today versus yesterday versus what is going to be tomorrow, is you're going to see that mortgage rates move constantly. And this is really in anticipation for the demand in the mortgage market. So if there are larger institutions buying a lot of mortgages, mortgage rates will actually drop, and it has nothing to do with the Fed. Or if larger institutions aren't buying mortgages, at least not as much, then mortgage rates might actually go up a little bit because there's not as much demand for those large institutions to buy the mortgages. I know it's getting a little bit confusing, but the point is your federal funds rate does not directly associate anything really with mortgage rates. It's more of what is going to happen over a longer period of time. And let me give you a real world example. As just recently, as I'm filming this in the beginning of October, we just saw the federal funds rate drop by 50 basis points, which is a fancy word for saying half of 1%. So the federal funds rate, the rate at which the Fed lends money to the banks, dropped by 0.5%. And what we have actually seen is mortgage rates increased almost by 0.5%. We saw mortgage rates hit almost 6% flat, and now they're up closer to 6.5%, at least at the time that I'm filming this. So how does that make any sense? Well, the reality is mortgage rates have been dropping from at the peak of almost 8% all the way down to 6%, all in anticipation that the Fed was going to be lowering rates over a longer period of time. And now when they finally do lower the rates, we actually saw mortgage rates tick up. So you can see there's not a one-to-one connection here. Now, that leads me to another major point that I want to make here, is that when you're looking at mortgage rates, there is a mortgage rate where if you just Google what is the rate today, you will see there is a rate. I like to go to Mortgage News Daily and see what they list the mortgage rate as today. And it's really just a baseline. And here's why, is there are a lot of different ways to get to your interest rate. And there isn't just one interest rate. There's a lot of things that go into consideration. Some things you know about and some things you might not. Here's a few just as an example. Is the things you probably know about is your credit score is going to affect your interest rate, your down payment's going to affect your interest rate, the loan amount's going to affect your interest rate, right? So it's important to understand that when the bank is figuring out what the interest rate is, they're figuring out how risky the loan is. So a smaller loan amount is inherently less risky than a larger loan amount. And on the flip side, so those are things you probably do know. The things you might not know is there's two different aspects of a interest rate. There is the, or I should say of a mortgage. There's the actual interest rate that you're borrowing it at, and then there's the cost to do the loan. Now what happens is you can get a more expensive loan that might have a lower interest rate, and you can get a less expensive loan that might have a higher interest rate. And at the end of the day, it is the lender who is lending out the money that is just making a decision. So one of the things that I like to have all of our clients do is talk with a lender that can go through and do a true total cost analysis, where you can compare 3 or 4 different options, 3 or 4 different interest rates with different costs, so that you can figure out the one that makes most sense for you. Now, here's my advice. If you are looking to figure out what is going to happen tomorrow with mortgage rates, you are speculating and guessing. If you are looking to figure out what is going to happen over the next 2 years with mortgage rates, at least as of right now when I'm filming this, we're all pretty confident we're going to see mortgage rates tick down over the next couple of years. So my advice to you is not to really look at this on a day-to-day basis, or more look at this like a trend. If you see the trend going down towards where you want it to be, you can be pretty confident that in the future, mortgage rates are going to be lower. Just the same through 2020 and 2022, through that stretch, it was pretty clear that mortgage rates were going to go up. So a lot of people took advantage of those low rates and bought earlier than they might have. Now, on the flip side, when we have rates trending downwards, you can buy into a property, then you have the option to refinance that loan at a later time. Now, if this speculating what is going to happen with interest rates sounds familiar, it's the same thing with prices. This is my last major point that I'll leave with you, is it's really hard to say what is going to happen next month with pricing. But it's pretty easy to say that over the next couple of years, we are pretty fairly certain that we're going to see more buyer demand, we're going to see lower interest rates, and we're probably going to see prices stay about the same and tick up. And that is the thing that is important to look at. When you're thinking about making a move, I say zoom out of just looking at what is happening right this very second. And if you zoom out and you say, hey, over the next couple of years, prices are probably going to be a little bit higher. Now, I'm going to break this down 3 different ways. I'm going to break this down for people looking to purchase a primary residence. I'm going to break this down for investors, and then I'm going to break this down for homeowners that are maybe thinking about selling or selling and buying. So for those looking for the primary residence, one of the questions I ask our clients is, if you're going to plan on living in this house for 5 to 10 years, use the example that I just shared, is what do we think interest rates, what do we think the price, more importantly, what do we think that's going to be 5 or 10 years from now when you're thinking about moving into the next home? And the likelihood is 10 years from now, real estate prices in Southern California are probably going to be higher than they are now. I think that's pretty safe to say. So for primary residences, find the property that you really want to live in. I think find your comfort zone as far as what you can afford. And if you want to go to onyxhomes.com/finance, we have a mortgage calculator that has a ton of detail in there and a little video of how to use it. This is something where you can go and find your comfort zone on a monthly payment basis. And if you want to connect with the lender, they can walk you through that total cost analysis. You can just fill out the form and do that there. But anyway, you want to find your comfort zone, because obviously we want you to purchase something that you're comfortable affording, of course. But we also want to make sure that you're buying something you really like, right? Especially if you're going to be there for 5 or 10 years. the difference of a few $1,000s on price or a few $100s on payment is probably going to be less important than the quality of the home that you buy that you're going to live in for that long. Okay, so that's for primary residence. Now for investors, super straightforward. Regardless of interest rates, regardless of price, if the math on the deal doesn't make sense, don't do the deal. If the math does make sense on the deal and you want to do it, well then the math says do it, right? And then that's just your decision at that point. I think that's the reality of, with investors, it's just very cut and dry. If the numbers make sense, do it. If the numbers don't make sense, don't do it. That's my advice for all investors, especially in the real estate field where it's just very cut and dry with numbers. Now, the last one is for current homeowners. So if you are in a home and you feel stuck and locked into your house because of a low interest rate, I'm going to go back to what I just said with the people looking for primary residence. Is, in my opinion, that's not a very good reason to stay in a home. Now, I understand it's that low mortgage rate. We're probably never going to see that 2.5% again. But there's two different options here. You can turn that current property that you live in now into a rental property. You might even be able to pull out some equity with a home equity line of credit, and use that towards your down payment, and then keep this as an asset and make it into a rental property and keep that low mortgage rate, and then go buy your next property. Or if you really don't like the house, is that extra, I don't know, look at the difference on your monthly payment. Again, go to onyxhomes.com/finance and just see what the payment difference would be. It either makes sense or it doesn't. You really want to figure out how much is that low mortgage actually worth to you. So at the end of the day, the point of this video is to make sure that you understand that the federal funds rate does not directly affect mortgages in the short term. However, in the long term, they actually do. So we are expecting to see the federal funds rate continue to come down over the next couple of years. So it's pretty safe to say we're going to see the interest rates tick down over the next couple of years, which they have over the last 6 months or so. So if you're thinking about making a move and you want to play with your affordability, go to onyxhomes.com/finance, play around there. And if you want to talk to somebody about that total cost analysis, fill out the form. Again, my name is Christian Stubbs. Hope you found this valuable, and I'll see you in the next video.